Chaos in Washington. Silence across the world. It started with 5 words, blunt, explosive, and echoed across the Treasury building. We sent the letters. That was the moment the global economy shifted. Treasury Secretary Scott Bessent, red-faced, and flanked by stunned aides, stormed out of a closed-door meeting. No deals, no diplomacy. Just a warning shot. 100 nations received tariff threats from Washington. The message? Renegotiate trade on America's terms, or face tariffs as high as 50%. But here's the twist. Most of the world didn't even reply. No calls, no meetings, no deals, just radio silence. A silence that speaks louder than any speech and reveals a deeper shift. Because this wasn't just a trade threat. It was a last-ditch move from a system that's fracturing. The ultimatum, the so-called tariff letters, hit inboxes across Asia, Europe, Africa, and Latin America. According to Bessent, they're designed to reset global trade. Critics, however, call them what they really are: ultimatums. Renegotiate, or face 1930s-style tariffs. But none of the targeted countries had asked to renegotiate in the first place. Vietnam, Mexico, South Korea, they might depend on U.S. exports, but the majority of the 100, they didn't flinch. Not because they're bold, because they've moved on. Out of those 100 nations, over 63 now trade more with China or India than they do with the U.S., according to Bloomberg's global trade trackers. They're integrated into new trade corridors, BRICS partnerships, UN-settled contracts, Belt and Road pipelines. They're not rebelling. They're ignoring. Washington's leverage fading. Trump argues that America's massive consumer market worth $3.1 trillion in annual imports gives it unmatched power. But leverage cuts both ways. U.S. importers are addicted to foreign inputs: batteries, electronics, pharma, machinery. Hit exporters, and you hit your own manufacturers too. Worse, retaliation is no longer theoretical. It's already underway. In 2024, BRICS trade surged to $4.6 trillion, up 5.2% year-over-year, even as Western economies slowed. Supply chains are quietly reorienting. Reuters reports that 37 countries have already adopted non-dollar trade systems. Brazil and Argentina now settle 40% of their trade with China outside the dollar. It's not speculation anymore. It's happening. Deadlines that aren't deadlines. The original deadline for compliance? July 7th. Then August 1st. Now it's simply imminent. Markets aren't fooled. When Bessent's press statement hit Bloomberg terminals, the S&P 500 dropped 2.1% intraday. It wasn't the tariffs that spooked investors. It was the chaos around them. And that chaos is spreading. Trump's recent $3.4 trillion tax package, passed just weeks earlier, is now stoking inflation fears. Add high tariffs on top of that, and the outlook turns toxic. According to the Joint Committee on Taxation, the top 20% gain 2.3% in income from the bill. The bottom 20%, they lose 2.3%. Tariffs don't just hurt trade partners. They crush domestic purchasing power. The BRICS penalty, then came another curveball: Trump's BRICS clause. A 10% automatic tariff on any nation aligned with what he calls anti-American BRICS policies. But what does that even mean? De-dollarization? Participating in a BRICS bank? Trading commodities in yuan? Under this vague umbrella, even U.S. allies like Germany or South Korea could face penalties for settling trades in non-dollar currencies. Brazil might be punished just for exploring a BRICS reserve currency system, even though that system doesn't yet exist. The threat isn't targeted. It's global. The system reverses. There's a brutal irony here. The U.S. built the global trade system it's now trying to dismantle. SWIFT, the IMF, the WTO, even the global dominance of the dollar. These were American constructs. But now, BRICS is flipping the architecture. Instead of breaking the rules, they're rewriting them. New settlement systems, local currency swaps, parallel infrastructure networks. And America? It's trying to protect a game that no one wants to play anymore. The math has changed in 2000. The G7 controlled 70% of global GDP. Today, that share is just 43%. BRICS? They've climbed from 18% to 34%. And the momentum hasn't stopped. By 2029. The IMF projects China alone will account for 19% of global output. If nations like Indonesia, Egypt, or Saudi Arabia formally join BRICS by 2026 as expected, the bloc could command 46% of global GDP and control over half of all critical mineral supplies. So how much weight does a U.S. tariff really carry in that world? A dollar in decline, the rise of non-dollar trade, is more than symbolic. It has real financial consequences. Less trade in dollars means less recycling of U.S. currency into U.S. treasuries. Bloomberg data shows foreign purchases of American treasuries fell by $289 billion in the last year. China alone slashed its holdings by $12 billion, the steepest drop since 2016. Meanwhile, Beijing is loading up on gold. In June, the People's Bank of China added 70,000 troy ounces, over 34 metric tons this year alone. That's not an investment. It's an insurance policy. Gold isn't subject to sanctions. It doesn't depend on trust in U.S. leadership. It just is. Europe's quiet shift even. U.S. allies are hedging their bets. A German church pension fund, one of the most conservative types of institutional investor, just committed $50 million to a Hong Kong-based China equity fund, according to the Financial Times, not just for returns, but for access to undervalued Chinese tech and industrials. Symbolically, it's huge. A NATO-aligned entity is betting on a market Washington labels a rival. Even the Hang Seng Index is reflecting the shift, up 21.3% year-to-date, compared to the S&P 500 6.7%. Capital isn't abandoning the West, but it's diversifying. That speaks volumes. The Hong Kong gambit, Beijing is preparing to go even further. Bloomberg reports that China may expand its southbound bond connect, unlocking the equivalent of $140 billion in yuan for Chinese investors to buy foreign debt. That might sound dollar-friendly, but it is the goal? To turn Hong Kong into a mature financial center that channels capital without relying on Wall Street. The city is preparing to list more BRICS sovereign bonds. The implications are enormous. If it succeeds, a non-Western capital market ecosystem will exist, and it won't need Washington's approval. Domestic fallout, inflation, inequality, and isolation, while China builds new systems. The U.S. risks policy whiplash. Trump's $3.4 trillion tax expansion has already added fuel to the fire. According to the Congressional Budget Office, it will push the U.S. deficit into unsustainable territory. Inflation projections for 2026 have already risen 1.7 percentage points. The Peterson Institute now warns that if Trump's full August tariffs hit, the U.S. could face 15 to 20% inflation, pushing household budgets to the brink. At the same time, BRICS is easing credit, cutting rates, and subsidizing key trade flows. America tightens. BRICS accommodates. The final crack? All this leads to one conclusion. The U.S. isn't just threatening countries with tariffs. It's alienating them from a system they no longer need. The same interdependence that once made America indispensable is now boxing it in. This isn't just a trade war. It's a financial migration. A quiet exodus from a dollar-based world. Use created the architecture. BRICS is now remixing it with local currencies, digital payment rails, and new investment hubs. The old playbook is being replaced. So the question isn't whether BRICS will back off, whether Trump will soften his stance. The real question is, can Washington still lead a world that's already left? Drop your thoughts in the comments. And if you found this insightful, hit like, and don't forget to subscribe. More breakdowns coming soon.